Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at Dalio Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Dalio Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Dalio Capital or Sunpoint Investments.
All right, guys. Today we're going to have a conversation around the idea that investors might consider or go beyond the traditional sort of 60-40 stock bond allocation. And the way that we got to this topic was Jack and I have interviewed over on Excess Returns a number of very smart, intelligent investors who have developed investment strategies that go beyond just your traditional stock and bond allocation. And so what we thought we would do today is sort of have a discussion with Matt as sort of the financial advisor, someone that's advising clients. We advise clients too. Matt is obviously does much more financial planning and wealth management, where we're more a little bit, investment focused. But have a conversation around sort of the idea of going beyond stocks and bonds and getting into some of these other more unique asset classes and just sort of thinking about what the average investor, how they may think about it and how maybe a planner also would sort of approach it and look at it for his clients. So yeah, let's just sort of open it up. I mean, Matt, from your standpoint, I mean, you've been working with investors for a number of years and advising clients. Like, how would you say, what percentage of your clients sort of do go beyond the traditional sort of just stock and bond allocation?
In a weird way, I was thinking about this. Like, it's 100%, right? Like, no matter what, it's 100% because everybody owns something else that's not a stock or a bond somewhere in their life. Like, do you guys own your house? Both of you have a home that you own?
Part of it. Yeah.
So part of your net worth is private real estate. Back to, like, we can't talk about markets without talking about marketing in my mind. So if the Rory Sutherland quote that a flower is just a weed with a marketing budget, like, we could call it your house, or we could say a significant portion of your net worth is tied up in private real estate. And I don't think that's not a factual statement. I think it is. So as advisors, a big part of our role is not just understanding how to think about public markets, but thinking about private markets and the stories that wrap into each. When we talk about like what's an alt, we're talking about alternative, making me think of Nirvana, but I'm going to stay off pop culture for a second. Like, what's actually alternative? When we talk about investments, an alternative is not a stock or a bond. But what we're talking about is either an alternate asset class. So are we talking about pork bellies, orange juice futures? That's an alternate asset class that you can theoretically invest in. Or are we talking about alternate trading strategies? Is it a long short portfolio? Is it block trading? Is it something else? So everybody owns alts to some degree. It's just a matter of how we think about it, both economically and also psychologically.
So first of all, I'm now going to try to look like a more sophisticated investor than I am, and I'm just going to tell people I have a significant amount of my net worth in private real estate.
Fantastic.
Although it's my house.
I think that's the pitch right now.
It may not be exactly what they think it is, but hopefully they don't dig into that too much, and I can just, I can seem like I'm the accredited investor that I actually am not. But I wanted to ask you, like, if you think about just the liquid portion of people's portfolios, or at least a portion that you are involved in. I mean, their houses, if we kind of take their house out of the equation, like, what percentage then would you say have something beyond sort of your traditional stocks and bonds?
most people, especially in the last several years, I would say most clients have some exposure to something that I would classify as an alternative. And that's by, again, the definition of, in some cases, it's an alternative asset class. In many cases, it's an alternative trading strategy or an alternative process from just being like a long only go out and buy stock thing. And a big part of that is because we spent the last 10 years, up until just over a year ago, we were in a ZIRP or a zero interest rate policy world. And that meant you needed other ways to drive total return and things like that to just make a diversified portfolio stay diversified.
So we do these show us your portfolio episodes. And, one of the things I always ask about is this idea of inflation. And I always get like this puzzled look on the person's face. Like, you're an idiot. Like, I ask them kind of how they're adjusting their portfolio for inflation. And they look at me like, what are you talking about? Like, I've built a robust portfolio to inflation. Like, a lot of times they'll show those 4 quadrants of different economic environments. Like, why would I make any changes for inflation? But then you think about like people that are in stocks and bonds, and you think about like 2022, and that's a year where, inflation can really wreak havoc on a stock and bond portfolio. So I'm just wondering, like, how do you think about like inflation in the context of like the portfolios you're building?
There's this story that I tell when I work with like some groups of college kids and high school kids on finance and investing stuff and just principles. And I always tell this story about just to think about McDonald's, not a company pitch, but just like think about McDonald's. McDonald's has basically their costs of the stuff that they have, the stuff to make a Big Mac, and then they have the cost of labor. And obviously they got to pay rent, utilities, the whole nine and whatever. And the whole reason we invest in common stocks in the first place is because we're taking a bet on the owners of these companies to basically say, how much does it cost to run our business, both in the stuff we need for our inputs and paying the people who work here to just turn the lights on again tomorrow? And the really long-term studies, Jeremy, the Big Mac Siegel himself, stocks for the long run. The idea is if you have a bunch of smart people who are looking forward and figuring out how to just turn the lights on tomorrow, that's why stocks are supposed to stay a step ahead of inflation over time. Now, that's like that concept is so important, just understanding first. Now, the other thing that happens, and this is like the deer in headlights look, I think, is, and especially in the last few years, we talk about investments in terms of regimes. And this borders on a little bit of a pet peeve I have with this thing. You can't talk about a regime, I don't think, without also talking about the bookends to that regime. And this is where I think stuff gets really interesting and gets a little confusing about thinking about the inflation debate. Because when we talk about a regime, what we're really talking about is what happens in some snippet from our data set. And I would argue you got to think about the bookends. Where do you start and where do you think you're going? And from that place of like, where did you start? We got to think about a number of other factors inside of the regime. Like, is inflation coming into the regime really low, and is it stable? And then is it going up from that point? And if it's going up, is it going up and accelerating? Is it going up and then accelerating up to a point when it's going to decelerate, then become stable, then roll over, then go down and decelerate, and then accelerate from there into a new place? So when we think about inflation in portfolios, it's not just a static snapshot. We don't just have like inflation was high in the 70s. No, inflation went up and down and accelerated and decelerated in the 70s. And when we think about our investments, be it traditional or alternative, we have to think about how they move through not just the regime, but also the bookends.
Yeah, it's interesting because even people who have stocks and bonds, these guys who we were talking to have portfolios that obviously have things in there for inflation. But like even people that have stocks and bonds, the question of, obviously I should change my portfolio for inflation is not an obvious answer because of what you said. Like, how is the inflation going to come about? Like, when do I add the commodities? When do I get rid of the commodities? Like, it becomes very, very hard. Like, you don't want to hold commodities as a long-term investment, or at least, you go through periods where they're going to do really, really bad and they're going to typically generate, a lower return than stocks and bonds. So it becomes like, it's very path dependent. So it's not that easy where it's like, if I should have something in my portfolio for inflation, let's go ahead and throw the commodities and the gold in there. Like, it's a lot more complicated than that.
Well, one of the things that you'll find too is that with a lot of these guys, that's where trend following and momentum comes in, because that is the signal that gives them the that makes them basically either move in and out of these asset classes or maybe take some risk on or risk off, because that's the only thing that's going to tell you. And you don't know whether that momentum is going to continue, whether it's going to break, but momentum is effectively like Jack, like we talked about, price is like truth, right? And momentum is truth. So that's in a lot of these strategies, these guys do use momentum as a strong indicator of whether or not they are in and out of an asset class.
Do you see a lot of like the typical inflation fighting assets in portfolios of clients, like commodities, real estate, tips, gold? I mean, do your clients hold a lot of that type of stuff, or is that stuff that's not that widely used? I mean, real estate probably is, but how about the rest of it?
So to each their own. And this is one of those things where you should never be like on a diet that's unsustainable, and you should never be on a diet that's unrealistic. Like if you hate broccoli, don't go on the all broccoli diet. If you love chocolate cake, that's typically not a good dieting tool. So you're not going to get the results you're seeking most likely. So before I say like what else people have, and we should talk about this because it's really important too. It's important to know, like if I'm just an institutional investor running money, I might have like a trend following CTA sleeve for inflation hedges in my portfolio that I'm turning off and on and up and down in different environments. And that's totally fine. But when it's real people thinking about consumptions and gifts over time, they have to think about like, what role is this playing in my portfolio right now? Is it just a diversifier? Do I need this for consumption? And then how do I stomach that in the math for how I build this thing? So what do real clients do? And they definitely do use alternatives in lots of different ways. It plays back into the plan and what the goals are for these assets and how they may or may not dampen or help us ride out volatility or different periods of time. And then another piece inside of this too is like how you get there for different clients can matter. So I don't know the math off the top of my head, but did a lot of stuff over the last 10, 15 years where it's like you can get the same exposure to say like gold in a modest inflation environment. You can have 5% in gold or have like 1% in gold mining stocks. And there's a lot of ways to strip these betas and correlations apart to build portfolios to do that. So it's selecting your alternatives, selecting why you want to own them, and then position sizing them accordingly for the effect you think you're going to get.
How do you think about the balance between simplicity and complexity here? We've a lot of these portfolios that were kind of alternatives to the 60-40 we've talked about were fairly complex. I remember when we were talking to Rick Ferry, he was talking about Wes Gray's portfolio. He was another person we've had on there. And he was saying basically, because Wes has a bunch of managed futures contracts in his portfolio. And Rick was saying, to Wes, like, good luck having your wife figure this out when you're not around anymore, like trying to unwind all these managed futures contracts. So like, how do you think about that balance? Some of these strategies make a whole lot of sense in an academic environment. Like if you look at it, like if you look at the return profile of the long term, they make a ton of sense, but they also introduce complexity. So I'm wondering, like, how do you think about that and people's ability to understand what's going on?
So I think you have to know if you're going to use something with an alternative trading strategy at its core, which is like a lot of like managed futures and stuff like that. You just got to understand the wrapper that it's in. And then if you're using that like in your family portfolio and say, I don't know how sophisticated the rest of Wes Gray's family is. Suffice it to say, if his kids are in charge and they take it to the beach in Puerto Rico or whatever, I guess like everybody can go surfing on managed futures, right? But the idea is like, you got to understand the wrapper. And with so many of these things, when we get into alternatives, it's understanding that the wrapper that it's in and what the consequences of this thing are if it needs to be unwound at some point in time. And there's lots of great examples of alternative investments where you're owning things in a certain structure because it actually passes on, turns into cash, and gets liquidated at another point in the future to someone else's advantage. So simple versus complex. Make it as simple and as complicated as it needs to be, but just back to the regimes and bookends. Hey, your life gets bookended too. You better have a plan for how other people are going to unwind these things. If you want to do fancy stuff during your life, like don't leave them the garage full of Beanie Babies. Like, clean that shit up.
I'm curious, just you may not use this at all for clients, but I'm just curious how you think about leverage, because that's something I've kind of come around on over time. Like, first of all, obviously when you use that word with any investor, panic like immediately comes in. Like, I'm going to blow everything up. But a lot of these guys we've had on have talked about the idea that if you're introducing uncorrelated, return streams with the leverage and you're doing it responsibly, it can actually, it can be a much more optimal portfolio. But on the other side of it, like, people might not understand exactly what's going on, and it's something you have to have some level of sophistication to implement. So I'm just wondering, like, from a planner's perspective, if you could talk about this idea of leverage and kind of what you think about it.
Well, suffice it to say that in your very large and astute private real estate portfolio. You've enjoyed the benefits of leverage, I imagine.
True. That is true.
Again, a flower is just a weed with a marketing budget. So leverages can be the greatest thing in the world and the worst thing in the world. And I think it comes back to, you have to understand, if I'm hiring a manager to use leverage in something that I'm doing, I better be comfortable with what those risks are and in what environments leverage is a quick path to clear and certain death versus in which environments they're like, hey, this is pretty sweet. This is a good deal. I once heard a absolutely bananas story about this guy who was literally, it was back in the days when, so probably right around the financial crisis or pre-financial crisis, he was getting these 0% credit card cash advances, and he was using them to buy these Canadian royalty trusts that paid 20% a year dividends or something crazy. And the crisis ruins all of this, right?
That ended badly, I assume, right?
Oh, it ended badly. The twist of the story is, I believe, and again, we'll protect the identities of people. Let's just say there was a lawyer in the family and there was some stuff with the credit card advances that I think he got out fairly okay. So that would be an alternative trading strategy I would not recommend. But I think he got out without destroying his entire family or legacy on this, but lots of irresponsibility on all sides. So leverage is one of those things. You better understand the terms of what happens when the people offering the leverage come knocking or come running or shut you off. And it's possible to employ leverage without getting yourself into trouble. But if you don't understand where the sources are or where it's coming from, just don't do it. Don't mess around.
One of the things we've seen a lot in the last few years is a lot of these complicated strategies that were usually only available to institutions are now available in the ETF format. We've had the Simplify guys on, they've done a lot of that. I'm just wondering, things like managed futures, you can now get an ETF, things even more complicated than that. Has that changed at all, what you do with clients, these ETFs being available? I'm wondering, how those get used, kind of in the real world, some of these more complex things that are now available via ETFs.
We talk all the time about sort of I hate the expression, the democratization of private investments and private equity and all these things that are coming downstream. But the reality, it's happening. And in some ways it's opening access. In some cases, it's just opening access with bloated fee structure. But in other ways, in building portfolios, you can resize positions and express views in a way that you just couldn't do before. So it's pretty amazing that in a zero interest rate world, you could go out and buy merger arb funds in a regular mutual fund wrapper. And even though they weren't earning really carry on the treasury portfolio that they'd lever up to hedge out these merger arb opportunities on announced deals, you could basically you couldn't get a short-term bond fund that was going to give you 4%, but you could get a merger arb fund that could kind of deliver that in that world. And so these tools being available for people who can understand them and then position them in portfolios to say, this doesn't have the same volatility structure as this other thing, but I can get to it in another way. That's beautiful. Likewise, last year 2022 was not a fun year in markets. But if you were well, we're a little worried about the tech sector, we're going to own a little more energy, a little bit less tech, and we want to use this call writing strategy on the tech and the growth stuff. So we'll de-emphasize the position, but we're going to monetize some of that volatility. There's ETFs to do that now. Not saying that should be all of your portfolio, but a slightly more tactical view, depending on what you need to get from your portfolio. You got the tools to do it. And that's kind of amazing when used responsibly.
This gets back to, I think, one of the most important things in investing, which is you have to understand what you're buying. And so these can be a little more difficult to understand. For investors who understand what these are, or it also adds, it's where someone like you can add value. Because you can really understand, it's not just what is the return profile of this. It's when things go bad, what does it look like? When things go good, what does it look like? What is the total package I'm getting? What environments does this do well? Which does it do poorly? Understanding that entire thing and not being surprised, not buying this new fancy vehicle and then being very, very surprised about a certain market environment comes and it doesn't do what you expect. Understanding that going in, I think would be really, really important.
Diversification means you always hate something you own. That's kind of the definition I always go back to. If we don't hate one thing in our portfolio, we're doing something wrong, we're not adequately diversified. We should always have something that we're why do we own this thing that is sucking right now? And with with all these new strategies where you can do all this stuff that institutions and others can do, again, you just have to understand its place, because it can really turn around and torch you on the other side if you don't understand, how does this suck? And why will I hate owning this at some point if it's for the long term? I got to say too, it's when you introduce like an alternative trading strategy, you have to know that's what you're introducing. Like, we joke about alternatives. Again, it's like if I own orange juice futures, like I know I own something weird. But when I introduce like an alternative trading strategy too, whether it's covered call writing or whatever, like there are ways to make money that are just based on the behaviors of others and exploiting different things in markets. They just don't work all the time.
Yeah, behavior is what I wanted to ask about for the last question, because, like, for instance, we had Wes Gray on. I mean, Wes is an iron-willed investor. Wes has a very different portfolio than stocks and bonds, but Wes does not care if he underperforms for 5 years or 10. It doesn't affect him. He's not judging himself against the S&P 500. But in the real world, that's not the way most people are. And so I'm wondering, how do you think through these things? Jim O'Shaughnessy always talks about this idea of 2 points of failure for an investor. The first point is when they have losses in the stock market, they might panic. The second is when they underperform their neighbor. When their neighbor's talking about the cocktail party about how great the market's doing and they're in some alternative strategy, they might abandon the strategy. And so I'm wondering just, how do you think about behavior in terms of introducing these things that make a portfolio look really different than stocks and bonds?
So my colleague, Michael Pompion's got some great stuff on this too. And he actually has something in his work that I think is fascinating and serves the points of the people that you just made too, is basically looks at biases, not from the point of like the advisor fixing the biases and all that stuff, because that's crap. But what is interesting is like different people have like different inherent blind spots. And if you just know your different inherent blind spots, like if you know that how good your neighbor is doing is always going to like torture yourself, you need to figure out how to like build a barrier around like not getting tortured by that. If you know you need to feel smart about stuff, you need to figure out ways to like implement a responsible strategy that makes you feel smart. If you really like saying everybody else who's fancy is dumb, build a portfolio that makes you go like everybody's fancy and dumb. And what we're trying to do is mitigate the disastrous behavior that comes into just like putting it in a coffee can in the backyard or whatever, where you don't earn these returns and you don't hit your goals. And if you're the mindset where the coffee can in the backyard is like the only way that things work out, to each investor, know thyself and find people to help you work your plan out, work out the things you own based on how you're wired. It's as hard and it's as simple as that.
Yeah, we have this portfolio called Permanent Protected Momentum we run. And, the idea is basically to have these other asset classes in a portfolio, but to use momentum to determine when to be in commodities and things like that. And, that one of the big lessons for us with that is this second point of failure, is that, it's very hard to use a portfolio like that for 100% of someone's assets, because a portfolio like that is very good around reducing drawdowns, but it's not as good around keeping up with the market during certain times. So during those raging bull markets, by definition of the way the portfolio works, you're going to be trailing. And, you need the right person in there, or you need to use it for a portion of their assets, not all the assets, so that they have something else that's kind of working in their favor when that might not be working.
Yeah, I'm reaching for this. This is, so Mike's book, Behavioral Finance in Your Portfolio, this one, delightful orange cover. Like breaking down those personality types and just understanding who can and should or would want to like have that portfolio, like in their mix of their broader portfolio, who would be all in on that, who should just never touch that at all, because it would just torture them that they have this thing that like, even when the market's down, it's like, but go be opportunistic. It's like, no, some things you have to buy low and sell high. Other things like momentum and trend, it's like buy high, sell higher, right? Like you're flipping this stuff all over its head with these different strategies. And that's the beautiful thing about investing. There's returns that are out there. There's ways to put money to work. We just have to find ways that it's working for us, not against us.
Matt, I'm just disappointed in the McDonald's example. You didn't bring up the Shamrock shake, which is my favorite thing to get from McDonald's.
Oh, what is that? I don't even know what that is.
How do you not know the Shamrock shake? Please.
No, it's like,
I really don't. I've never heard of it.
Yeah, it's like a mint. It's like
it's like a mint shake or something.
Yeah, it's like a Shamrock. Okay. For St. Patrick's Day, they do like a special shake where it's like a mint shake, which is awesome.
I do have a McDonald's story though that I didn't use. That's not the Shamrock Shake, but like I kept thinking about, and now I'm interjecting this at the end here. The chicken nugget story? It's like the greatest alternative investment story in my mind ever. Do you know where the chicken nugget came from?
I think I've heard part of this. Yeah, but you should tell it.
Okay. So essentially McDonald's has this like consultant for them, and we'll say who that is because that's what makes the story in a second. But McDonald's wants to do the chicken McNugget, but basically can't figure it out because like beef was really easy to like hedge and get everything and control the cost of the beef patty, but chicken was like really annoying and they couldn't figure out how to do it. And so in a great flex of alternative investing, this little consultant named Ray Dalio comes along and figures out how to basically like hedge out the risks and the volatility of chickens. So it was like a combination of like wheat and chicken futures, I think, that he put together so that McDonald's could literally roll out the chicken McNugget in whatever year that was. Was it the 80s maybe?
Yeah.
And basically how McDonald's can do that in a profitable way. So here what we have is we have an alternative trading strategy to drive the profits for like McDonald's equity investors from this thing. So it's like alternatives are everywhere. And it's just those two things. It's an alternative asset or it's an alternative trading strategy. And they get put into practice by equity holders, by bond holders, by just people in society taking their kids through the drive-through because chicken McNuggets and a Shamrock Shake is what the Irish intended when they set out their diet all those years ago.
Nice. Good little ending there on McDonald's. So just in summary, I think if I could key on one word that was probably used the most in this podcast, it's understand. So it's understanding the options you have. It's understanding the regimes you're in and how they're bookended. It's understanding the wrapper, understanding the risk you're possibly taking with allocating to alternative investment strategies, understanding that there's a total package and that there's a place in someone's portfolio potentially for these different types of strategies, but also understanding that, when stocks and bonds are, moving in certain directions, that these types of strategies are going to be, possibly different. And then also understanding your own behavior as an investor. And if strategies like the ones that we've been talking about and the ones that we've highlighted on excess returns from our guests could work for you. So I think that's ultimately what it comes down to, is sort of getting an understanding of these things and then figuring out if it's best for you and your long-term investing approach. So hopefully you guys found this valuable. Thank you for listening, and we'll see you next time.
Hi guys, this is Justin again.
Thanks so much for tuning into this episode.
You can follow Jack on Twitter at @PracticalQuant.
You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at CultishCreative.
If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment.
Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.